This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
Got a great segment coming up to continue the macro talk. We've got our colleague Rich Miller, who's on my team, when I'm doing the rest of my job, which is covering the economy. So Rich, good colleague of mine based out of D.C., he's with us on Zoom. And Ira Jersey, our chief U.S. interest rate strategist, with us here in the Bloomberg Interactive Brokers studio. How are you guys doing?
I'm doing great, Molly. Thanks very much for having us and having me in the studio.
Yeah. It looks like investors, I think we're saying in something of a holding pattern ahead of the inflation data tomorrow and, of course, the Fed decision on Wednesday. So let's get a preview of all that. Ira, who's in studio. By the way, do you know the difference between suspenders and braces? Because Ira can tell you.
Please tell me, Ira.
One has buttons, one has clips.
There you go. Keep that in mind. So with the guy with the braces, he's the most important one, I suspect. He's also in studio. So Ira, what is the market expecting at this point, and what do you suppose the Fed's going to do, and why is there such a disconnect, or if there is one?
Well, the rate market is thinking the Fed's not going to do anything this week, right? But the question is, will they start to get more dovish, right? And certainly the market has completely shifted tone the last 6 weeks, where at the beginning of October, we were basically pricing for the Fed to do almost nothing in 2024, maybe a cut at the end of the year. Now we're pricing for 100 basis points of interest rate cuts starting in March, right? So we're going to be definitely listening for any tone shift from the Fed. That's a big one. And if they were a little bit more hawkish than they were, say, last month or what you heard in the minutes, then you can probably start to price out that March cut that's already priced in the market.
That is really dramatic to move up from basically no cuts to now starting as early as March. Rich, let's bring you in here because you had a great story over the weekend as to the question isn't so much about the when, but the why. So tell us about the reasons why the Fed could cut and why that matters.
Well, two basic reasons. One, the economy's falling apart and then they've got to come to the rescue. So in that case, probably the cuts will be rapid and big. But the other one, which Governor Chris Waller floated, would be if inflation keeps falling, they bring down rates in tandem with the fall in inflation. So they effectively keep the real rate, interest rate, after adjusting for inflation, steady. And so that would be sort of good news, certainly good news for the economy, because it would be suggesting that the economy is cruising along. We're in this soft landing, inflation's coming down, immaculate disinflation, et cetera.
Hey, Ira, when things turn, they usually turn pretty quickly and pretty severely. How dramatic of a turn have we seen when it comes to parsing the data?
Well, not that dramatic, right? We've seen a mix of data, right, where some data is certainly weaker and the data is certainly, not falling off a cliff yet. But to your point, John, and it's possible that you get this, a massive downshift in the economy, and that would be one of the reasons why the Federal Reserve, as to what Rich was just saying, that would be one of the reasons why the Fed would start to cut early. Now,
that's a minority view to put that out there, though.
Probably, but at the same time, if that does occur, then certainly the Fed might cut much faster, right? Typically, I call it escalator up, elevator down, right? When the Federal Reserve hikes interest rates, it increases them relatively, slowly, although, in this cycle.
Just 4 75 basis point hikes in quick
right.
succession.
A little bit different, right? But when they cut, 100 basis points at a time, maybe for 3 times, right? So you can wind up with very significant declines in it. Now, that's not my call, and I actually think that the market's probably getting ahead of itself, because I do think that, that Governor Waller and some of the other members of the Fed, they would love to be able to kind of calibrate the federal funds rate with inflation and with the growth level, but it's very hard to do, right? So I agree with the idea that we need to know why they're going to be cutting early, and I'm not convinced that they need to or they're going to.
Yeah, and Rich, let's get into that a little bit more in the story, because when I pointed out why they'd be cutting because of a recession and being a minority view, it looked like in the survey that Bloomberg did earlier this month was, what was it, about 28% of people who thought that would be the reason why the Fed would be cutting, but closer to 3/4 thinking it'd be more along the soft landing narrative that inflation is cooling and that would warrant a lower policy rate. So tell us, for those people who are in more the recession camp, I mean, there's not many of them left. Why do they think that's still the case?
Well, I mean, some of them include our own Anna Wong, who's our chief economist. True. So it basically, I think the people who are arguing that there's still a recession likely, I guess, have a couple of reasons. One, if you go back in history, people are always talking about soft landing just before recession. So that's one. But two, I think it's more about that the interest rates will slowly start to weigh on consumers, companies, and that consumers have more or less exhausted all their surplus savings, and now they're having to borrow credit. People point to a buy now, pay later has ballooned, and the companies, many of the companies, the rates they locked in will be coming due, and they'll have to refinance. So that's the argument of, as you say, sort of dwindling minority at the moment of people who think a recession. I mean, what was kind of interesting in the survey was that, just looking ahead to the meeting, is that the median economist we surveyed, says the Fed itself is only going to have 2 interest rate cuts penciled into their dot plot, and that's just half of, as Ira was saying, that's just half of what the market is expecting the Fed will end up having to do.
Is it instructive, Ira, to look at history, the interval between hikes, pauses, and cuts? Does that tell you anything?
I mean, it's not a time thing that the Fed really worries about, right? It's where are we in the economy. But there is a cyclicality to the business cycle, for sure, right? Where you do have troughs and valleys in economic momentum, and but sometimes those manifest themselves in mid-cycle slowdowns. I mean, I'll take 2015 as a perfect example, where you had some massive sectors of the economy that were in recession, right? You had the oil patch was in recession for sure, but we didn't really fall into the category of making it a recession because it wasn't incredibly broad-based. And it's possible that we could be in a situation like that, right, where we have a meaningful slowdown right now that winds up accelerating sometime in the not-too-distant future, and we don't technically get a recession. But it doesn't matter. The economy is slowing, right? There's, I think very few people and objective observers would deny that. The question is, will the pace be slow enough and broad enough that it worries the Federal Reserve, and is it slow enough that inflation comes down enough for the Federal Reserve to be comfortable cutting?
What's the history of soft landings? Do we have a good track record of that?
You could argue we had one in 1994. You can argue that we had one or two, but yeah, they don't normally happen, right? The Fed cuts usually because there's an emergency, and it cuts a lot.
Yeah, I mean, what kind of emergency do you think that would be at this point, Rich? That jobs report on Friday certainly doesn't look like any emergency in the labor market right now.
Yeah, I mean, in our survey sort of said that one other option would be because some sort of financial shock, and for the moment, none of the economists we surveyed are looking for a financial shock, which gets you a little worried. But that would be something. As I said, the people who see a recession sort of say, okay, things are always bright before it turns dark or something like that, and that that this interest rates have an impact. High interest rates have an impact, and they will basically wear the economy down to recession. Albeit most people think it's going to be very mild, but still. That's I mean, I think what will be interesting next week will be the Fed has kind of in its statement has a bit of a tightening bias. Will they reword that? Some economists like Michael Gapin of Bank of America are suggesting they may even drop that. And then the other thing, as I mentioned earlier, will be the dot plot, and how many rate cuts they've got priced in. At the last press conference after the last meeting, Powell said they weren't even thinking about rate cuts. They're not talking about rate cuts. It's going to be hard for him, I think, to say that this time.
Rich, always a pleasure. Thanks a lot. Rich on Zoom from Washington, D.C. Rich Miller, our economics reporter, and in studio with us, Ira Jersey, the chief U.S. interest rate strategist with Bloomberg Intelligence. Of course, the Fed meeting Wednesday, and the Powell press conference will be specifically looking for the summary of economic projections. You're listening to Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
You know, New York, Molly, has been winning listings from London. The chipmaker
stock listings, that is.
Well, stock listings.
Yes,
yeah.
the kind that our listeners care about.
What'd you think I was talking about?
I don't know. I mean, my mind's been in the real estate space lately.
Oh, that's right. Just closed. You closed over the weekend?
Just signed a contract.
Oh,
a big step
goodness.
toward closing.
You become a big girl now.
Oh, my goodness. You better believe it.
Mortgage and everything. Well, Chipmaker Arm, when you talk about listings, that's the one that immediately comes to mind. Based in Cambridge, listing in New York. With that as a backdrop, let's explore the ties between our two great cities, New York and London. And we're honored to say hi to Chris Hayward, the policy chairman for the City of London. So New York and London, are we friends, enemies, frenemies, competitors, something else?
Well, I would say we are first and foremost friends, and also just a little bit of competition between our two great cities as well. But as far as the listings go, I mean, I think both our exchanges have had challenging years, ours more than yours. We know our listings are down in London, and really that's down to availability of capital and capital flows, and particularly we've seen it with fintech and fintech sector. Companies who we would have hoped would have listed on the London Stock Exchange have come across the pond because they can get bigger valuations here. There's more capital availability. But our regulators have adjusted some of the restrictions on listing on the London Stock Exchange. And so we're hoping to continue to win business in a friendly and competitive way with you in New York.
Is it too much regulation in your city?
We don't think so. We think that high quality regulation, financial regulation, is actually very important. It's important to attract foreign direct investments into our country. But at the same time, it mustn't be restrictive. It has to be innovative as well. And the one thing you do much better in New York than we do is you actually take risk in business. And unfortunately, regulation has become something that's seen as not innovative, not promoting global competitiveness. We're very keen to see them do that, but not to downgrade the quality of our regulation.
Got it. Well, Chris, tell us a little bit more about your title. We were trying to understand this a little bit before. Your distinction as policy chairman, what role that really entails, and also a little bit why you're here this week.
So the policy chairman of the City of London is the political leader of the corporation, serves for 5 years. We have 120...
Well, that deserves explanation in itself.
Yeah.
There's London and the corporation, which is in the
square mile,
the square mile of the city.
So
where does that get its roots? The corporation.
The corporation goes back over 1,000 years. It is the oldest part, the heart of London in general. London in general is made up of 32 different London boroughs and the City of London Corporation. But our job specifically is to promote UK financial and professional services, and to represent them both to the UK government and internationally. So my job sees me doing 65 days travel around the world, promoting London as a global financial capital.
And to that end, you're opening an office.
We are. Now, this is something I've wanted to do for a number of years now. We have global representation in other countries. We haven't had it here in the US, and so I've hired a managing director, and we're going to work between DC, where we obviously have the regulators, the Hill and the think tanks, and New York, where you obviously have the commercial and financial center. The idea is really to talk together about regulation and alignment of regulation and policy areas as well, and of course to promote flows of trade and investment between our two great nations.
So tell us, Chris, because admittedly, so like I said, I'm a huge fan of your city. I studied abroad there when I was in college. Have been dying to get back. My memory, though, of the financial center of London is that it's largely Canary Wharf, right? Is there a whole lot else going on beyond that area?
Absolutely. I mean, what you will find in Canary Wharf are some of the big banks, some of the big investment banks, but you will find huge amounts of financial services companies and some banks in the square mile itself. What happened is, we only have 1 square mile. That's a tiny area to actually be able to cope with the explosion of growth in the past 20 years in the financial services sector. And so 15 years ago, a number of them moved to Canary Wharf. Some are now moving back into the city, but we still maintain that the reputation, when you're talking globally, what people remember is not Canary Wharf, they remember the City of London.
It's not a one-way street. There's U.S. investment going to London. Tell us about that, particularly with venture capital.
With venture capital particularly there is, and that's hugely important for us. And what I've been doing today, and I will be doing in the next few days here and in DC, is I spoke today with the New York Stock Exchange, and we agreed to mutual collaboration. Although there is competition, there's no reason why we can't equally support each other's aspirations, and there's lots of ways we can align. And one of the encouraging things is we do get two-way flows. It's not just one way. We do have US investment into the United Kingdom, and that's been growing, and the VC market in particular.
And tell us about investment then from other countries, as much as we sometimes like to think the U.S. is not the center of the world. So tell us what's happening elsewhere.
Well, look, we've been through a very difficult challenge over the past 7 years with the Brexit debate.
Sure.
And leaving Europe and leaving the EU, leaving the single market. So that's forced us now to look globally. And we've been doing free trade agreements around the world. And unfortunately, I don't think we're going to get a free trade agreement with the US. But that I don't think will stop us trading as we do, very effectively between the US and the UK. I don't think either of your political parties here have an appetite for free trade agreement with us, but nevertheless, there is a tremendous flow of business and trade and investment going both ways across the Atlantic. And we know this transatlantic alliance, this friendship has been around for decades and centuries, in fact, and what we want to do is take it to its next level. That's why we're opening an office here.
What excites you the most about this relationship and where it's headed?
Well, I think we have lots of things in common between the United States and the United Kingdom. We both speak the same language. We both have a slight different accent to it, maybe, but we do both speak the same language. We're both financial capitals. Look, New York, we have huge respect for New York and the New York Stock Exchange, and I think the City of London is reciprocated. We see ourselves as a global financial centre. So what excites me is how do we bring the two of us together to strengthen the alliance in the Western world between these two great financial capitals?
Yeah, in financial houses in New York and even places like Bloomberg, you sort of cut your teeth in London at some point in your career. You're sent over there, and that's like a...
Have you been with Bloomberg or otherwise?
You had to ask, didn't you?
I had to.
I've been, but not for work.
Okay, just for fun. Well, have you been to our office over there, Chris? I hear it's quite the marvel.
It is a most remarkable building, the most sustainable office building in the whole of Europe.
That's correct.
It's a fabulous building. I go on the radio, Bloomberg in London regularly. I do Bloomberg TV regularly. And I have met your great Mr. Bloomberg last week at the COP, actually out in Dubai. So I went to the Bloomberg dinner, so I was very lucky.
Oh, fantastic. Well, we love to hear that. And thank you so much for...
I haven't been invited to the new building yet.
I haven't either. No, maybe that'll be our next big break.
You need to get an invitation. You really do. And come and see us in Guildhall in the City of London when you come.
Where's the office opening in New York?
Well, we at the moment, we're working between New York and DC to identify locations in both, and we'll bottom that out. So we've appointed the MD. We'll bottom that out in the next few months.
All right, keep us updated.
Fantastic. Appreciate it. And Chris Hayward, the policy chairman for the City of London, deepening the relationship, the ties between New York and London.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Have you booked a hotel in the Big Apple lately?
In the city where I live?
I don't know.
Oh, come on,
It
Sean.
was almost a rhetorical question for the listeners and viewers out
Right.
there. So I did, because I had to do a quick turnover, and I don't live here. I live in another state. But my eyeballs almost popped out of their sockets.
Scary stuff.
Oh, goodness gracious. I didn't pay for it. I mean, I put it on the Amex. But anyway, our next guest follows the hotel and hospitality industry pretty closely. Kevin Davis is CEO of America's Hotels and Hospitality at JLL. So how does the Big Apple stack up right now?
The New York City hotel market is performing exceptionally well. In fact, we are having a record year from an average daily rate perspective. We're up almost 13% compared to 2019 and over 22% compared to 2022. So incredibly strong dynamics in New York City.
So how much of this, Kevin, is like pent-up COVID demand versus, I'm sure you get this question a lot, I see you already rolling your eyes, or is this like
that was
really...
a smile, by the way.
Okay, we're smiling, but
Yeah.
you know, I mean, really, is that a valid question?
Look, some of it's pent-up demand. There are also some supply dynamics that are taking place in New York City that I think are unique.
You're a typical
to-
New Yorker, by the way. You're like, why would anybody want to come here?
I love living here, and we're going to ask Kevin why my real estate investment is going to appreciate.
There you go. And I'll tell you why. I'll give you 50 reasons why. But look, the reality is part of it is pent-up demand. I think part of it is there's a supply story, there's a demand story. So from a demand perspective, sure, people are continuing to travel post-COVID. I think COVID unleashed this you only live once mentality, and I think a lot of people are continuing to travel as a result of that and want to get out and experience the world. We've seen a return of international travel to New York City, which is a significant demand driver in this market. Interestingly, the Chinese, which historically have been the second largest foreign demand group, they recently relaxed their group travel restrictions, which is a big driver of traction of travel to New York City from an international perspective. So we expect to see significant inbound Chinese travel, as well as from some of the other foreign jurisdictions. The other dynamics that we're seeing, return to the office and return of business travelers coming back to New York, staying in hotels, group travel, meetings taking place, which is also driving demand. From a supply perspective, a couple things taking place. We've had a significant influx of new hotels over the past 10 or 12 years in New York City, which we expect that influx to decline pretty significantly. There was a legislative initiative passed several years ago, which makes it much more difficult to build new hotels in New York City. You effectively need City Planning Commission approval to get a new hotel built, which makes it a lot harder to build new hotels. So ultimately, there will likely be fewer new hotels built. Also, Airbnb, the city passed regulations which make it more difficult for homeowners to essentially put their properties on Airbnb. So we've seen a meaningful decline in Airbnb as a result.
So an investor who wants to capture some of this upside potential, what do they do?
Look, there are properties certainly on the market. We expect that there will be a lot more properties on the market over the next 12 months for sale, which should drive significant volume. And interestingly, in 2023, we've actually had a meaningful uptick in investment sales activity. Almost $3 billion of hotels have sold in New York City, which is a record. That's October year to date, which is a record relative going back to 2015. So we haven't had this strong of an investment year since 2015. A lot of the reason ties into a couple of things that we talked about before. Difficult to build, hard to build, a lot of demand for people wanting to come to New York City and stay in hotels. So that's a trend that we expect will continue well into 2024.
Yeah, so let's recap on this, what you just said here, Kevin, because I heard that all of the demand indicators look like they're going up. A lot of the supply ones are going down.
Correct.
That sounds like a nice recipe for inflation.
Well,
for higher hotel rates, at least.
Higher hotel rates. How's that? Now,
Okay.
Look, the other side of that is, I mean, labor costs have gone up, so it's certainly more expensive to operate a hotel in New York City.
Again, we can
costs,
pass those on through
taxes,
the higher hotel rates.
that is certainly possible in some instances. But yes, there have been higher costs, but obviously rates across the city are at record highs. Look, the other dynamic that we're seeing, about 12% of the hotel rooms in New York City are being leased out to migrants. So that's a fair number of rooms. Call it 17,000 hotel rooms in New York City are actually effectively offline because they're being used by the migrants.
The metric by which we judge success in the hotel is revenue per available room, right?
That is correct, RevPAR.
How does that work? I mean, I wish everybody would just use the same accounting standard.
Oh, we need one for each industry, John.
Well, it counterbalances your average daily rate and your occupancy. So it tells you effectively if your rate is one number and your occupancy is another number, you multiply those two together and you get what is revenue per available room. So it's actually what you're getting as a function of the occupancy.
So as John was just saying, I am in this apartment buying journey that I've been taking the listeners through for several months now. And I'm always looking for reasons as to why my investment is going to do well. So, I mean, tell me, it sounds like there's a lot of great factors for, like you just said, tourism in New York City. What does that mean, if anything, for the residential market here? Is there any reason to think that strength on the tourism side could be good for the residential market too?
Yeah, absolutely. Particularly if we start to see more foreign investment in residential real estate in New York City, which has historically been a big driver of demand in this market. So certainly we could see overflow. One of the interesting dynamics at play is a lot of foreign investors, either for their own country, as a result of their own country restrictions, visa issues, have not been able to visit New York, meaning they haven't been able to look at hotels that they may be interested in buying and or residential real estate. So I think as some of those barriers have decreased over time, we should expect to see more foreign investment in New York City. Absolutely, from a hotel perspective, I would expect that will continue from in the residential context. Interestingly, we've seen a meaningful uptick from Asian buyers and Middle Eastern buyers in the hotel space in 2023.
And in New York, the most sought-after spaces seem to be at opposite ends of the spectrum.
Yeah, that's correct. And it's not just a New York City dynamic. It's across the industry more broadly, where you've had strong investor interest in luxury assets on one end of the spectrum, and then select service and extended stay assets on the other end of the spectrum. You might ask why that is. Both those sectors have performed incredibly well in a post-COVID environment. And given the strong operating performance, you've seen a meaningful interest in those asset classes on the part of investors.
I lobbied to do this interview at the Carlyle. They turned me down, though.
Carlisle's a nice place to stay.
Yeah, well, not just I know the downstairs restaurant, the restaurant downstairs.
Oh, I was thinking the Carlisle Hotel on the Upper East Side.
Yeah,
where Roger Federer stays during the U.S. Open.
Yes,
obviously.
Where Bobby Short used to play in the Carlisle Cafe, right? That leads me to my next question. What's your favorite spot in New York City, the hotel space?
Oh wow! I mean,
you have to give us an honest answer. You can't say, there's so many. There
are so many amazing hotels. I tell you, I'll name one where I had breakfast this morning, which is an absolutely lovely hotel, the Whitby Hotel. On 56th.
I don't think I've ever heard
56th and
56th between 5th and 6th.
Okay, smack in the middle of Midtown.
There you go. You go. It's a great hotel. But of course, New York City has a bunch of wonderful hotels. The Carlyle, the Equinox.
Ooh,
the Crosby
music
Street
to my ears.
Hotel.
The Equinox Hotel.
Nice. Spaces I'll never go in. Spaces they'll never let me in. Kevin, good to see you. Thanks for stopping by the studios. You notice he didn't do this via Zoom because he's,
we love him.
I'm local.
Yes,
I'm
yes.
local.
He's a local guy. The CEO of America's Hotels and Hospitalities for JLL.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Much more than this, I did it my way.
All right, thanks, Frank. Frank Sinatra. You ever heard of him?
He's not Taylor Swift, but,
That's
I've heard of him.
more my cup of tea. Anyway, John Tucker, Molly Smith with you. Argentina has a new leader. Javier Milei got there promising to fix the economy. Now he seems to be ditching some of the key pillars of his radical economic platform. Manuela, Tobías, and Joel Weber put together a story on Argentina's new leader, and they join us now. Joel, he's practicality, it seems, would be giving way to some of the promises that he made.
Well, there were some big promises before the election, and what's happened, that election was last month, and over the weekend we had an inauguration, and basically everything he ran on has become sort of a big question mark, because it seems like he is tacking in ways that are totally unexpected. And I think Argentina, which is, if you look at recent history in Argentina, has been through the ringer, and it looks like more ringer ahead. So Manuel, bring us up to speed on how Argentinians are feeling about this election and the person that they put into the presidency.
Yeah, I think a great way, you summed it up pretty well. We've been through the ringer here in Argentina. And Milei was this radical candidate who came onto the scene literally with a chainsaw, saying he was going to burn down the central bank and dollarize the economy, ditch the Argentine peso. And he took office on Sunday. And basically what we saw is a much more moderate president. Also said he was going to cut ties with China and Brazil, our biggest trading partners, and then very, very amicable, greeting with all of the foreign ministers yesterday. Basically these radical proposals that he said he would do on the campaign trail. He's toned them down, and we very much saw that in his choice of cabinet members. All the people who were there at his victory party just a couple weeks ago, we've seen them leave in different forms. And at the same time, this might be like, oh, he's not the person he said he was. This is actually really, really promising for Wall Street. We saw sovereign bonds go up 30%, really rally, and he's given some really promising signs in these last couple of days, last couple of weeks, that it's a question mark what that radical fan base thinks about it, but it's given the market some much needed calm in these last months of hectic times in Argentina. Just to give you context, we're at 143% inflation and already expecting double digits this upcoming month.
Oh, scary numbers. And we think we've got an inflation problem here in the U.S. So, Manuela, tell us, though, a little bit about the rationale for this abrupt pivot, because it really, like you just said, is just so completely different from what Milei was campaigning on. Was he getting pressure to tone down some of these policies?
Yeah, so Milei, he comes onto the scene in August in this primary where polls show him a distant third place, and he gets first with 30 percentage points. That's when everyone goes mad. They say, oh my goodness, this person he didn't even think he would get here, promising to burn down the central bank, suddenly gets first place in a primary. And then we see him plateau in the general election, which took place in October, where he still gets 30% of the votes. So he doesn't grow, but his one of the contenders from the pro-business party, Patricia Bullrich, comes in third with 24% of the points. So, the ideas sort of align, but you've got the opposition divided in two against the current left-wing Peronist party. And basically they join forces in the November runoff. And so you've got Milei's 30% hardcore voters joined with this more moderate pro-business 24%. And I think that's what we see. We see him sort of tone down because he needs the votes, but also now he needs to govern. So in order to even just fill up his cabinet, he had people with no government experience from the private sector, but also just a lot of academics, people who had just never had this kind of responsibility, who are now going to have a purse of billions of dollars. And so I think we saw what we were hoping and expecting, which is just now you have to govern. You're not the same person as you were on the campaign trail. You're responsible for 46 million Argentines. And so he toned it down and ditched those friends who got him into power in that.
So Joel, let me ask you, what's the outlook for Argentina now?
Well, I think that's the question, right? Like, are we going to be using pesos still? Or is it going to eventually become dollars, right? And I think, Manuela, you hinted at this, and I'm curious to like bring it back to you, is like, this guy was willing to just basically burn it all down. That's what he ran on. And now it seems like he's maybe actually been an establishment candidate all along. So how is Wall Street, to see the bonds rally like this, like what is Wall Street seeing that, maybe Argentines are not seeing?
I think, this is going back to the speech that he gave yesterday. Yeah, yesterday was Sunday. It's been a long couple of days when he swears into office. He, in some ways, he didn't change his speech. What he says is we've been in, a 100-year decline, and things need to be, changed fast. And this is what Mauricio Macri, president 2015-2019, breaks with, more than a decade of left-wing Peronist rule, says he's going to change things up, falls into gradualism, isn't actually able to put in the changes that he said. This guy comes along, says some really crazy stuff, ends up, moderating himself, because also something that I didn't say earlier is he has tiny fraction of minorities in both houses of Congress. So you simply cannot dollarize the economy with such little representation. And so I think what's so promising about what he says is he is telling Argentines straight on, like, this is going to hurt. We're going to do a massive fiscal adjustment. He even warned of 15,000% possible inflation that we're inheriting from the previous government.
Oh my gosh.
He's laying it all out real upfront. This is going to hurt. We're going to have to do some big changes, some big budget cuts. And I think that's a little bit the message and the embrace from the population of, yeah, we're ready for that. We want that change. Even though, he presented it as this chainsaw, but I think what Wall Street likes is, you've got this population who's finally ready, or at least claims to be ready for radical change. It's not going to happen because it's simply not possible to happen in Congress. And so you meet somewhere in the middle. And I think that change is what we need so badly in Argentina to get out of this inflation. Maybe this guy has the answer.
So tell me more about this guy who potentially has the answer. He sounded like kind of a nut job.
Well, that's when he first came on the scene, and Manuela, you know this extremely well. It was like sort of like, who is this guy, right? And he would say
he's a bachelor,
he
hasn't been married. He's
stuff,
sort of
right?
like calls his dogs his children.
Some
Which
people
is like,
do that. It's part of a culture.
Well, he takes
We
it to
won't
an
comment.
extreme, but no, it's just like.
In what's crazy is like in Argentinian politics, that's maybe not so crazy. Like this is a country that has seen a lot of flamboyant people in politics. But what's interesting was like the fact that he had that staying power that we kind of talked about, and not only was it, and that's I think speaks to the desperate nature of who's voting. It's like like you have this inflation for this long, people are willing to take a big risk. He represents that risk, but the thing that again intrigues me in all of this is those establishment figures that he's been willing to lean back into, Manuela. Who are some of the people, like, yes, some people spoke up for him and were excited about him, and yes, they are no longer there, but there are also other people that have been sort of central in, like, the Caputo administration, even that when Caputo was there, like, so who are these other people that he has turned to who are sort of establishment candidates?
Yeah, it's funny because first you ask sort of like who is he, and then who is his team, and it's night and day, because Caputo, who was actually finance minister under former President Mauricio Macri, that pro-business president we were talking about earlier, who wasn't able to enact the change. Milei had some really harsh things to say about him when he was in that role. He said he smoked away $15 billion, really criticized his time at the central bank as well. This is a Wall Street trader at heart, who did have very, very prominent role under Macri's government. Left with some problems with the IMF program. Didn't leave under the best conditions. I think it was 2018 in Macri's government, and now he put him as his econ minister. And as central bank president, we've got one of his right-hand men, Santiago Bausili. This is the guy who said he wanted this guy meaning Milei, who said he wanted a totally independent central bank, and who was going to give the keys to Emilio Campo, the author of his dollarization plan, to close down the central bank. So you went from independent, burned down central bank to the right-hand man of the econ minister at the helm. So that is to give you a little sense of how far we've changed, pivoted. So those are the top econ ministers, and we've got in defense and security, we were going to have the Vice President, Victoria Villarroel, who he spoke at length on the campaign, was going to handle those issues. And now our new security minister is going to be Patricia Bullrich, who was the pro-business candidate who got that 24%. So his rival on the campaign, turned ally, who helped him get those votes, is now head of security, which is a big, big issue here, because we've got 45% now poverty, 143% inflation. You can imagine the sort of issues we're dealing with, much more and more insecurity on the streets.
A great story and a great read. Manuela, thanks very much for being with us. Appreciate it. Manuela Tobías on Zoom there from Argentina, and Joel Weber, Bloomberg Businessweek editor. Argentina with its new leader, and apparently any number of defections. People sort of disenchanted with the way things are going, at least his most avid supporters.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
You're listening to Bloomberg Businessweek. I'm John Tucker, along with Molly Smith.
Yes, another wonderful Monday afternoon together.
Yeah, absolutely.
Usually in the morning for us, though.
But as
us.
utility infielders, you got to get used to different shifts.
That's right. We're pinch hitting today. And for our good friends Carol Master and Tim Stenovic, who are elsewhere,
and they should be back soon.
They will be. Don't worry.
Don't worry. A bit of caution, I'm going to say, kind of seems to be permeating some of the markets today as we wait for the inflation data. We get that tomorrow in the form of the CPI, and of course the Fed meeting Wednesday. So, Molly, what's an investor to do? Let's bring in the next guest. Jeff Krumpelman is Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors, joining us from Cleveland. Cleveland, the home of
Or Cincinnati.
Oh,
Even better.
Cincinnati. Okay.
Not the Rock and Roll Hall of Fame. Is that where you're going with that?
No, I was going to say 3159 West 11th Street, which is the Christmas Story house.
Oh, okay. A little different. Well, anyway, Cincinnati sounds lovely this time of year. Thanks for joining us, Jeff. Yeah, like John just said, lots going on to parse through this week as far as investable decision-making things going on. So where's your head at right now going into this week? A lot of things going on.
Well, we just had a lot to celebrate, I think.
With the jobs report?
Well, sure, the jobs report, and I just think the plethora of data through the year, we were positive going into it, I think, when the rest of the world, or a lot of the world, was very negative. Things just didn't need to be hunky-dory. They just need to be less worse. And so inflation trends, and we get the CPI report tomorrow. So inflation trends have pretty consistently since June of 2022 been trending in a better fashion. And the economy is held up pretty well. So we're going to get retail sales, and we're going to get industrial production. We had a nice employment report, as you cite, last Friday. So the consumer's employed, making pretty good wage. Costs are coming down from painful levels, and things are just better than feared. So I don't know if there's much to focus on and to do. You don't want to get complacent, but I would say enjoy the fact that we are, in a fairly healthy backdrop, and maybe others will start appreciating that more and more as we see other strategies taking up price targets. And so 2024 could be shaping up to be, I'm sure we'll have wall worry items that crop up, but a fairly decent year.
Jeff, explain to everybody what happens for managers like yourself as you go into year-end tax loss harvesting. How do the dynamics change for the next couple of weeks?
Well, it can cause a rally in different types of stocks as the losers, you're going in and you're going to try and capture a loss where it makes sense to do that, unless you think there could be a snapback recovery. People will harvest losses, and then you have to go somewhere with those stocks. So one of the things that we've been thinking about in year end, you really have seen a very narrow market this year, right? So everyone's talking about Meg 8 and Magnificent 7. And we've tried to be a little more diversified than that. And we do think that it's a little overdone. There are a number of tech names that have done well this year, but there's a lot that have not done as well. So you sell your losers and you move into these areas that have not participated along with Omega 7 or 8, and you get a pretty hard rally in some nice growth names. And so that's what's going on. And I think you're seeing the market broaden out a little bit as values starting to outperform. Your equal weighted S&P 500's outperforming market cap weighted. Your non-Meg 8 tech names are moving in a good direction, and you can see kind of a risk-on attitude that's developing as we make some of these shifts.
Totally. I mean, that growth story, those Magnificent 7, that was obviously the big story of that November rally. What do you think the big theme is going to be for this month and just heading into the new year?
I don't think there is a theme. We said all year that this can be a really fertile market if you are a active stock portfolio manager and an active strategy. And, we've been saying that for just a long time. And I kind of was getting to the point where I thought maybe I'm a dinosaur. Maybe everybody's just going to ETF it and go passive. And certainly this has been a year where in our more aggressive strategies, we've outperformed very handsomely because there have been a lot of stocks on sale that have great earnings. And once balance sheets matter and rates start rising again, some people are able to invest and obtain capital and drive margins, and some folks can't when rates move up like they have. So I don't think there's a theme. I think if you look at consumer discretionary, you look at technology and healthcare, those traditional growth areas, there's some really attractive names. There's a capital spending boom that's underway, on the other hand, that makes us very, I think, attracted to industrials and some of your material stocks, like a United Rental, a Jacobs Solutions, a Deere, an Eaton in the industrials area, or a Vulcan Materials or a Ball Corp within materials. So I think there's a capital spending boom as we re-onshore that's out there that might be one of the underappreciated themes that you're asking about.
The correlation between stocks and bonds, I guess, has been a little muddied. 60-40, is that still something?
Yeah, I think, this is last year you could have panned 60-40 as we had a down year in stocks, 22% down, and then bonds also weren't a great total return play. This year you've seen the opposite thing after this November rally where you've made money in, I think, stocks and bonds off of very weak levels. And, at the end of the day, let's sit back and gain perspective as all these mood swings are all over the map. And this timing, 60-40 is bad, no, it's good, no, it's bad, no, it's good. Quite frankly, over the last 5 years, in the S&P 500, which is part of that big 60%, you're up 12% a year, which is above the long-term average for all the moves and all the angst. And, I think that it's still alive and well, and feel very good about prospects as rates stabilize and the market looks pretty strong in the equity sector for 2024.
Good to see you, Jeff. Jeff Krumpelman from Cincinnati. What's it, WKRP in Cincinnati?
Windy City? No, that's Chicago. Oh, what do I know? Somewhere in the Midwest.
The Windies. You're as bad as I am. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.